Diversification is a word investors hear often, but when it comes to applying it to their portfolios, the reality is not always clear. Many believe that simply adding a few different investments is enough. But true diversification is about combining asset classes thoughtfully so that each contributes differently across market conditions. In this episode of Nivesh Pe Charcha, the Diversification Playbook, we're exploring how can diversification be made more real for investors. Guiding us in this conversation is Mr. Ajit Singh, MD and CEO of Air Warrior Money Private Limited. With over a decade of experience in wealth management, he leads business development and operations, working closely with clients, including high net worth individuals, to design long-term strategies aligned with their goals. His journey is inspiring, from serving in the Indian Air Force, where he was recognized for leadership and discipline, to building a career in financial services, where he has managed high-performing teams and driven growth. Today, he will share his perspective on how investors usually think about diversification, what often gets overlooked in practice, and how a structured approach can help in creating more complete portfolios. So let's get started. Hello everyone and welcome to Grow AMC. Today, we're going to talk about how diversification can be made more real for investors, and for that, we have Mr. Ajit Singh joining us today. Hi Ajit and welcome on board.
Thank you, Karunya.
So, to start with, Ajit, when you speak to investors, what do they usually think diversification means?
Diversification actually means different thing to different investors. Like, let me put few categories of diversification that investors think that diversification is. Let's say there is an investor who comes to the mutual fund thinking that within one AMC, one fund house, if they have 7 to 8 schemes, that is a pretty much diversification because they have all the categories, large, mid, small, multi, whatever they have. So they feel that within AMC they have 6, 7, 8 products and they are well diversified. Is it diversification? The answer is yes, it is, but within AMC. Now the next set of investors who may think that this is best performing scheme of mutual fund, for example, let's say small cap or any other category, and they go to different AMCs and buy only that product, like the small cap from 4 or 5 different AMCs. Again, that is a diversification, but within that category, and the risk could be quite high. The other category of diversification could be like having large cap, mid cap, small cap, multi, flexi from different AMCs. So there is a AMC diversification. There is also the category diversification. Again, the answer is it is a diversification. And yet there could be other category who come to mutual fund thinking that mutual fund is one way of diversifying their money. The other could be physical gold. All of this. So lot depends on where the investor is coming from and what is the situation of investor coming to the marketplace to find what is suitable for him.
Right. But in the real portfolios that you look at, what is usually missing and how does that affect the outcomes?
As we all understand, the markets behave in a certain way. There is some period which is good for equity. In some other period, equities have not done well at all. So, if some asset class is not performing well, then it is a normal tendency for an investor and also marketplace to talk about those products which are doing good. So, the normal tendency of investor and also the marketplace, the entire ecosystem is to talk about that product which is high in performance, relevant for the period. So, the challenge is someone who is just following the what is trendy, what is performing. That's a real challenge. Diversification is not just about owning something which is performing, it is also about having something which is not done so well for so many periods. For example, if we talk about the asset class like gold, if you start from 2012, for the fairly 7, 8, 9 periods, gold has hardly given any performance. Now, the challenge is to have something in the portfolio even when it is not performing. So, these are some of the problems faced by investors, that something which is not doing good in the portfolio for a very prolonged period, there is always a question whether to hold that asset class in the portfolio or not.
But do you think investors get stuck with familiar products even when their goals may be different, or they may need different type of assets to be included in their portfolio?
Good question. Large number of investors we guide definitely understand for a very long-term investing horizon, equities are good asset class to have. For example, it beats inflation. They want to participate in the growth story of India. They also meet various life goals, financial goals. Because if they're stuck with a very low yielding product and the goals are many, incomes are limited, they will probably fall short of meeting so many obligations. Therefore, they clearly understand that equities are good asset class. There are few investors, few people who think that if the asset class is doing well, but let's say equity, which is inherently for a very long period, sometimes they get tempted to have it even for a shorter period, Whereas there could be something like debt, liquid, so some other liquid asset class which will be non-volatile in nature for a shorter period. So yes, large number of investors do understand, but there is a minuscule percent and tendency of people to also consider the long-term assets for short-term goals, which is a mismatch.
Okay. Perhaps, a multi-asset approach can make it easier for investors to build portfolio without adding to the confusion or to the, misinformation of any kind. Don't you think?
I definitely think because this gives fund manager an opportunity to, because investors come to fund managers through distributors, advisors to get the benefit, the knowledge that the fund managers have about the macroeconomic fundamentals and other things. They have a better understanding of the asset class behavior, which asset class is underperforming at the moment, what to add, what to reduce from the portfolio. So the whole reliance of an investor to the ecosystem is based on the ability of fund manager to do the things right. With multi-asset allocation, the fund manager caters to many things. May cater, right? Right. For example, the taxation of debt mutual fund has been taken away. But if debt is inserted into a asset class, which could be let's say multi-asset class, it takes care of the taxation part. Similarly, you may have gold in the portfolio, and depending on the proportion, sometimes the allocation to gold may warrant the more exposure to the portfolio. Maybe then a merely 5% to sometimes 10% if the fund manager thinks that there should be more allocation. So with multi-asset allocation, the fund manager does have an opportunity to still be tax efficient in today's times by having representation of debt, equity, gold, or any other asset class.
All right, great for sharing those insights with us, Ajit. It was a pleasure having you on board with us.
Thank you, Karunya. Nice speaking to you.
I hope this conversation with Mr. Ajit Singh has shed light on how diversification can move from being just a concept to something investors actually practice in their portfolios. To address some of the very challenges that we discussed today, Grow Mutual Fund has introduced the Grow Multi-Asset Allocation Fund, which seeks to invest across equity, debt, and commodities within a single portfolio. The NFO period is from 10th September to 24th September 2025. Please consult your financial advisor before investing and read all scheme-related documents carefully before you invest. Here's to making informed, thoughtful choices that aim to support your financial journey ahead.
म्यूचुअल फंड निवेश बाजार जोखिम के अधीन है। योजना संबंधी सभी दस्तावेजों को ध्यान से पढ़ें। म्यूचुअल फंड इन्वेस्टमेंट्स आर सब्जेक्ट टू मार्केट रिस्क्स. Read all scheme related documents carefully.